Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Wendy's stock is a buy. Wendy's, stock ticker symbol WEN, is a popular fast food chain with a sizable dividend. With Disney activist investor Nelson Peltz having a major position, Wendy's could present an interesting investment opportunity. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Wendy's. Wendy's was founded in 1969 by Dave Thomas, a milkshake salesman with a big dream. His vision: hot, juicy burgers made with real ingredients, served up fast and friendly. The first Wendy's popped up in Columbus, Ohio, and the company grew rapidly, serving iconic square burgers. Wendy's menu is a symphony of crave-worthy classics including spicy chicken sandwiches, frosty desserts, fresh-made salads, and those irresistible Baconator fries. Today, Wendy's boasts over 7,000 restaurants worldwide, employing hundreds of thousands of people. Now let's look at the price action. Starting with the 1-year chart, we see that Wendy's had a CAGR of about -17%. Zooming out to the 5-year chart, we see that Wendy's had a CAGR of 4%. Wendy's share price has been trending upwards for some time but has been in decline recently. Does this represent a buying opportunity? If we perform a backtest comparison of investing $10,000 in Wendy's versus the S&P 500, we find some disappointing results for Wendy's. In that comparison with the S&P 500, $10,000 invested in Wendy's would have grown to just $13,763 or a 5% CAGR versus $19,709 or a 12% CAGR if invested in the S&P 500. This demonstrates underperformance for Wendy's. Additionally, a Wendy's investment would have been more volatile with a 27% standard deviation versus 18% for the S&P 500. Wendy's outperformed the S&P 500 in terms of the best year performance, for which Wendy's grew 45% versus S&P 500 31%, and worst year performance where Wendy's fell only 10% versus the S&P 500 18% fall. In terms of max drawdown, Wendy's fell 33%, more than the max drawdown of 24% for the S&P 500. Unfortunately, Wendy's underperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio despite its excess volatility. Now let's hop over to market share and take a look at Wendy's market share. So we come over here and type in the ticker symbol for Wendy's and see that the market share is 0.24% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that less than 0.25% of all money spent for food or beverages goes to Wendy's. This tiny market share has also been shrinking. The 5-year market share CAGR for Wendy's is -1%. This means that Wendy's is losing about 1% of their market share every year. If we start in 2019, we see that the market share was 0.25%, 0.25% in 2020, fell to 0.24% in 2021, up to 0.25% in 2022, and back down to 0.25% over the trailing 12 months. Wendy's is slowly leaking market share. If not at Wendy's, then where are customers choosing to go for fast food? In this newest version of market share, we can actually perform a sub-analysis among a basket of similar companies. For instance, if we want to compare Wendy's against one of its peers such as Jack in the Box, we find some interesting results. Out of those two companies, Wendy's currently has a slightly larger share of the market at 56%. However, Wendy's appears to be losing 3% of their market share to Jack in the Box every year. This is not a good sign. Let's take a look at the fundamentals. Gross margin is 35%. This is similar gross margin to its peer companies. Revenue has compounded at around 7% over the past 5 years and has reached over $2.18 billion most recently. Revenue is clearly growing, but we know from market share that consumers are increasingly spending food money elsewhere. Looking at cash flow, we see a 5% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 6% CAGR. As a result, free cash flow has grown at a 5% CAGR. Despite capex increasing to nearly $100 million over the trailing 12 months as Wendy's continues to grow, the company has managed to keep growing free cash flow. This points to operational efficiency in the business. Weighted average shares outstanding have fallen a lot over the last 5 years, going from 253 million shares in 2019 to 214 million shares most recently. Wendy's has been busy buying back shares. Almost 3% of shares are bought back and retired every year, which shareholders love. Now let's view return on invested capital. Return on invested capital has risen from 5.2% in 2019 to 6% in 2023. This is not that much of a gain. At least the trend is moving the right direction. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 19 days in 2019 to 26 days most recently, Wendy's has become less efficient over time. I am not happy to see this value going higher. Now, let's look at Wendy's debt. The net debt to EBITDA has fallen over the past 5 years, going from 7.8 in 2019 to 6.7 most recently. A net debt to EBITDA of 7.8 is ridiculously high, so I am glad to see that the debt level has been reduced. However, 6.7 is still pretty high to me, so the debt situation at Wendy's is a red flag for me. Last, let's explore dividends. Current dividend yield is a reasonable 5.24% with a dividend payout percentage of 93%. Wendy's is paying out dividends that its earnings may not be able to support long term. This indicates that the company's dividend may not be sustainable. Dividends per share for this company have grown at a 37% dividend per share CAGR over the past 3 years and a 22% dividend per share CAGR over the past 5 years. Looking at the dividend per share chart, we see that the dividends per share have been rising since 2021. The fundamentals of Wendy's are pretty mixed. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. The channel has grown so much recently, so thank you for your continued support. It really means a lot. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Wendy's. It is a restaurant company with a gross margin of 35%. The 5-year revenue per share CAGR is 9% and the 5-year free cash flow per share CAGR is 8%. This is not too bad. A return on invested capital of 6% is small, but hopefully it is a grower, not a shower. Next, the cash conversion cycle of 26 days is higher than I would like. Ideally, the company would have a negative cash conversion cycle, which would indicate inventory and supplier leverage. Concerning debt, a net debt to EBITDA of 6.7 means that it would take Wendy's over 6.5 years of earnings to pay back their debt. This is way too much debt. Now let's switch our attention over to valuation. Wendy's is undervalued relative to the S&P 500 with a ratio of 0.8. The price to earnings growth, or PEG ratio, is 1.7, indicating that Wendy's is overvalued relative to their projected earnings growth. Wendy's has had subpar growth over the past 5 years, as noted by its market share shrinking. Management has clearly been focused on share buybacks and paying a dividend. I think these two actions have helped prop up the share price but will not catalyze growth going forward. The large dividend payout ratio and massive but shrinking debt are also huge concerns for me. If we look at Nelson Peltz's investor report from Q3 2023, we see that he increased his Wendy's position by 61% to a 10.4% holding in his $6.6 billion portfolio. Maybe he knows something we don't know, but knowing what I do know, I would probably stay away from the company. For me, Wendy's relatively slow revenue growth, large dividend payout ratio, and massive debt will keep it from going on the watch list. Many thanks for watching. What do you think about Wendy's and their debt? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.